Lynn, there's so much here to unpack, and I think we're just like peeling back the layers of the onion here. But I want to make sure that listeners get kind of their Econ 101 definitions of fiscal dominance and versus monetary dominance by way of maybe example, right? So fiscal dominance, that is like a government. So both fiscal and monetary, I guess, policy is what governs the money system of any sovereign country, right? So we understand that there's these two pieces. And in order to identify like which is which, when we see things like quantitative easing or buying of bonds or interest rate increases or decreases, all of the Jerome Powell Fed type of activity, that's going to be more the monetary policy type controls. Whereas on the fiscal side, when we see things like you mentioned, like COVID, the COVID stimulus or the PPP loans, or even like more recently, the Inflation Reduction Act, kind of like congressional, we are spending this amount on X program, that is more on the fiscal side of things. Would you say that's accurate? What are some like examples in each so that listeners can good at identifying the differences between monetary and fiscal?
Yes, that's accurate. I think we can make the example more clear by referring to time periods. And so, for example, when people think of inflation, they often think of the 1970s. The 1970s was a very inflationary environment. That was mostly inflation from bank lending. So there's two main ways that new broad money enters circulation. One is fractional reserve bank lending, and then the other one is monetized fiscal deficits. So, and you can quantify the size of what's happening there. So in the 1970s, I mean, they were running deficits, but if you look at kind of how much new bank loans are created each year, that was a larger number than the size of the fiscal deficits that year. And especially when you kind of look at that over any, say, rolling 5-year period. And so basically more money's coming because banks are lending. And the reason that was happening, there's a bunch of reasons, but basically the baby boomers were entering their home buying years. So you had a big demographic surge, a lot of people kind of hitting their period of peak credit formation. And back then houses were cheaper, so people could buy homes earlier. They bought them often in their 20s or, sometimes early 30s, but they could start buying homes on average earlier than people do today. So this big generation's coming into their home buying years, their family formation years, this kind of peak credit formation. Banks are making a lot of loans. You have money supplies going up very quickly. And then you ran into price inflation because you had that higher than normal rate of money creation at the same time as you had obviously constraints in oil supply, and we're also running some background deficits that weren't helping, even though they were a smaller force. And the way to get that under control was that Paul Volcker, the head of the Fed, raised interest rates to the highest level they've ever been in the United States. And the reason that was effective was because the federal government only had 30% debt to GDP. So there was not a lot of debt on the public sector, and there really wasn't even a ton of debt on the private sector, but he was able to raise rates super high. And what that did was that slowed down borrowers wanting to borrow money. Who wants to borrow money at double digits, especially if that's much higher than the inflation rate. So real high nominal rates and real high rates compared to the kind of measures of inflation. And so that really slows down the ability and the desire for people to borrow money, and it slows down that rate of bank lending. It kind of pushed the economy into a credit contraction recession. But you kind of wash out some of that inflation from the system. You kind of reduce demand enough to allow supply to catch back up to it. And so that's an example of monetary dominance in action, both the cause of inflation and then the response to having that high inflation. Whereas another big inflationary period in the U.S. was the 1940s. And people don't really think of that decade when they think of inflation, but that was roughly on average as inflationary as the 70s. But that was the last time we were in fiscal dominance. And so in the 40s, banks were not lending much at all. That was not a period of rapid bank lending. Instead, the obvious context was World War II. And so they had already gone through the Great Depression. So they already had the big private debt bubble pop, and they started rotating that more to the public ledger. They kind of got stuck in this period of stagnation. But then, as populism grew around the world, partially because of economic reasons, war broke out. And when it came to war, they did these massive fiscal deficits, the biggest deficits relative to GDP we've ever seen. They were even bigger than what happened in the 2020s. And a lot of that goes to fighting the war, but that's going to commodity development. That's going to manufacturing. When the GIs come home, you put them through college and technical school and subsidize their mortgage, and it's it's just
big
kind of
government spending programs, basically.
exactly, yeah, really big stimulus in various ways, and it's a lot of that. The bonds they issued to fund all that, because it's a tremendous amount of bonds. They were bought by the Federal Reserve, increasing their monetary base. Then they were bought by the commercial banking system on fractional reserve leverage. And so you had this huge spike in the money supply, but it was not because banks were lending. It was because these really big monetized fiscal deficits were plowing money into the system. And the Federal Reserve, they were basically captured by the Treasury. So they kept rates low, despite the fact that inflation was very high, because if they raised rates, it wasn't going to change the decision of Washington. They're not going to not go fight this battle because of what the Fed's doing. They're not going to change any of that. And so it's entirely different tool set around that. And so eventually after the war, they pivoted more toward austerity, and they had a number of kind of things in their favor to grow out of that problem. But that's an example of fiscal dominance at its most extreme. Whereas the 70s was more so a monetary dominance. And today in emerging markets, you see often there is fiscal dominance happening. Probably the clearest case of fiscal dominance today is Japan. So they have over 250% debt to GDP. Bank lending is not at a very high rate at all. It's some of the lowest rates of bank lending in the world. Their money supply increase, it is still fairly slow, but the increase that does happen is largely because the government's running deficits, and then the central bank is helping to monetize those deficits. And so higher interest rates have a mixed success record of dealing with that, because it's not like they're going to change their government spending much based on what the central bank does in the same way that the private sector responds. And so I think that's kind of a good baseline to set it is where's the money creation coming from, and what tools are able to slow down or not slow down that money creation.
I think this is great, and I think that no one listening has really lived through a fiscal dominance era. So we're going to have to bring in some of those examples later in the episode, where you talk about the U.S. in the 1940s and like what was that like, or Japan today, or like an emerging economy, an emerging country. Like maybe we can draw parallels there. But I want to ask you another point on the timeline that is probably closer to lived experience for the listeners to this podcast, and that is something we all remember, which was 2008 and the big bank crisis. Now, applying what we kind of like just learned here, Lyn, and you check me, we were squarely in monetary dominance territory, and the tools to like fix the financial system that was utterly broken and like plunging us towards the deepest recession, maybe depression since the 1920s and 1930s, was a monetary intervention. And it was almost squarely a monetary intervention where rates dropped down to like, zero. And there were the bank bailouts, of course, quite famously. And that's where like some of us started to learn this like very esoteric term called quantitative easing. These were all monetary policy instruments. I don't recall much of any fiscal policy intervention. In fact, that was some of the criticism here. And there was like an entire social movement, Occupy Wall Street, for instance. Why you bailed out the bankers, use your instruments of monetary policy, but there was no fiscal policy intervention. Like people didn't get stimulus checks. Like, Main Street didn't get bailed out. And so check me on that. Was that purely monetary policy intervention? And like, if so, why didn't we use more fiscal policy at the time, or like some combination of both?
So that was kind of the beginning of where fiscal started to become relevant. So that was a mix of monetary and fiscal response, because that was a private sector debt blow up for the most part. And so the biggest response there was monetary, mainly in the form of cutting interest rates to zero and then doing quantitative easing. There were some fiscal components, but as you pointed out, they were more targeted on banks. So some of the bank bailouts involved a combination of monetary and fiscal policy, because they did things that the Fed is not authorized to do on their own. And so some of that was actually injecting solvency into the banks, not just liquidity, but the other part was monetary. To the extent that there was fiscal support to the rest of the economy, that was pretty minimal. So, for example, there was things like cash for clunkers,
I do remember this. That was like what they it was a government program to like buy your used car. Was that what this
Yeah, it's
was?
basically it incentivized people to get rid of their older car and buy a newer car and try
Right.
to help them out while also helping out kind of industry. But that was, that's like basically laughing stock in terms of size compared to the things we saw in these recent years. They were also, I mean, they gave a little bit of a boost to seniors. It was like a tiny little stimulus check. If you were unemployed, your benefits were a little bit higher than normal. So around the margins, there was a little bit of fiscal support, but more of the fiscal support was directed at the banks to recapitalize them, and then it was a very large monetary response. And when you look at another way to phrase it is what is the fiscal support relative to? So, for example, during that kind of 2008, 2009 period, a lot of loans went bankrupt, so they defaulted. And one of the few ways to really destroy money in the system is to default on a loan or pay back a loan and don't refinance it, actually pay it back. Those are methods to either rapidly or slowly reduce the amount of money supply in the system. And so during that period, because of loan defaults, the money supply would otherwise have shrunk a little bit. And the fiscal support that they did was about the same size as the loan defaults, and also just a slowdown of lending that occurred. And so they basically balanced it in such a way that instead of getting deflation, we just had like zero inflation or like really low inflation. You might have had like a couple quarters of the way they measure it, deflation. But it wasn't like some gigantic, huge thing that was way bigger than the amount of loans being destroyed. Whereas when you fast forward to say the 2020s, these stimulus checks were, order of magnitude bigger. The stimulus checks, the child care tax credits, the PPP loans that turn into grants, the corporate bailouts, down the line, all these kind of things that happened, and the magnitude of those was way bigger than the loan defaults. And so that was a net huge increase in the money supply in a way that did not happen in 2008. So 2008 was like hints of fiscal, still mostly monetary, whereas by the time we got into the 2020s, monetary policy is still a present force, but the fiscal side is so much larger.
Lynn, is this too simple an explanation? So both the fiscal and monetary policy interventions like increase generally, always like in the direction of increasing the money supply. It's just a matter of kind of who gets it. And when a policy tends towards monetary policy intervention, then asset prices get inflated, right? And we certainly saw that from like the time of the interventions in 2008, like onward, just massive run-ups in stocks and all sorts of risk on assets. And on the other side, when there's a fiscal policy intervention that tends to go towards kind of like, I guess, more directed to Main Street and wage increases or direct stimulus checks. And that causes inflation of a different type, which is a bit more of the consumer price index, CPI type inflation. So is that oversimplifying the explanation of saying monetary policy equals asset price inflation, fiscal policy, like intervention increase equals consumer price index, CPI inflation?
I would say for the most part, I mean, fiscal can do both. I mean, fiscal when they use it is probably it's generally a more powerful tool than monetary. So it can actually impact both asset price inflation and consumer price inflation. Whereas monetary policy is generally more impactful on asset prices. There are some levers, of course, where monetary policy can impact CPI. For example, if a currency has negative real rates, nobody wants to hold it. If they raise interest rates, it could convince more of the foreign sector to go and hold that currency, which helps it find a floor, so it stops devaluing, and therefore it can, say, put a lid on energy prices or other import prices. So both of those types of policies can affect asset prices or consumer prices, but it largely depends on who's being stimulated. So if you're mainly stimulating banks, for example, that's not going to contribute to too much CPI growth. Whereas if you're sending money to households, you are going to impact consumer price inflation at a much more a higher level. And another factor that's kind of worth clarifying here is it's not just the size of the deficits or the monetary policy intervention, it's also the amount of aggregate debt that's on the public ledger. Because that's why if it builds up enough, it starts to kind of invalidate monetary policy. So an example of that is during the 70s, federal debt to GDP was 30%, right? So when they raised interest rates, when Volcker raised interest rates, it put downward pressure on private sector lending, but at the same time, it put upward pressure on interest expense from the government, which is ironically kind of stimulatory. That's money, that's a fiscal deficit that's flowing out from the government to whoever holds those bonds. And so you're basically you're with one hand you're pushing down, the other hand you're kind of stimulating. But because federal debt was low, and most of the money creation was coming from banks, the downward pressure was a lot bigger than the upward pressure, which is why it was effective. Whereas when you go to today, when you have over 100% debt to GDP, the problem is that when they raise rates, they do put downward pressure on the private sector lending. We've seen that in the current data. Lending is slower than it was a couple of years ago because rates are higher. People aren't rushing out to buy homes or, re-leverage their homes, and, corporations with high debt are running into issues. So it is putting downward pressure. But the problem is that the interest expense that it increases for the federal government is like 4 times bigger when you're at 120% debt to GDP than 30% debt to GDP. And that is flowing to entities. If someone has locked in a fixed rate mortgage, they have money market funds or T-bills or whatever. Every time the Federal Reserve raises interest rates, the government is now paying them more money, whereas their mortgage is locked in. So they actually have more spending power. And there were corporations that did the same thing. There were corporations that just termed out debt for 10, 20, 30 years. That doesn't get affected anytime soon. Every year a little bit of it matures, but it's not a big deal. Whereas any sort of big cash position they have in T-bills or whatever else they're holding it in, that's paying them more every time the Federal Reserve raises interest rates. And so that's one of the key reasons why structurally fiscal dominance starts to take over and limit the options of monetary policy, because what we normally think of as what central banks should do in the face of inflation is they should raise interest rates. But then after a certain point, you go through that looking glass where, you're raising interest rates and it's only moderately effective because you're stimulating as much as you're pushing down. And if you go far enough, like if you get into Japan's case, it's so lopsided at 250% debt to GDP and almost no bank loans that interest rate increases would almost certainly be somewhat stimulatory for inflation, ironically.
I've heard people describe like monetary policy in that condition as like pushing on a string. It's just like you keep pushing and just nothing happens.
Yeah, and it's just that's kind of the transition you go through, and that's also why it's not 100% versus another 0%. It's like as you kind of get more and more debt on the public ledger, there's no magical line where that starts to switch over to fiscal dominance. It partially depends on different countries have different policies for like what kind of mortgages they have, right? So a country with more long-term fixed rate mortgages can enter fiscal dominance at maybe a lower level than a country where all of those are adjusting upwards quickly, right? So there's no one magic number, but as you over time, as you kind of move more and more debt to the public ledger, all those fiscal sides starts to take over, and then even the monetary policy tools that are meant to slow down inflation become less effective, and in rare cases even counterproductive. And again, there's always multiple forces. So for example, if they raise interest rates, like let's say the Bank of Japan raised interest rates, it would make more of the foreign sector maybe want to hold yen, which could slow down the yen descent and therefore, kind of slow down the increase in oil prices in yen terms. That's one of the disinflationary factors it would have. But it would also increase the deficit more because all that 250% debt to GDP would start maturing into higher and higher yielding assets, and they're not going to let the sovereign default. So the central bank's literally going to increase their balance sheet to kind of facilitate, all those monetized fiscal deficits, which at the same time is increasing the money supply at a faster rate. And so that's really where fiscal starts to take over compared to the monetary.
To continue leveling up your crypto game, then you need to get on the Bankless newsletter. It's the world's most popular crypto email and is completely free. Just click below to sign up.